podcast with the Value Hound Academy. You're listening to another exclusive interview with the leading authority in the opportunistic and value real estate investing space. With the real estate market recovering from historically low prices, many real estate investors are looking to raise money from investors so they can capitalize on today's great buying opportunity. To help give us some experienced advice and insight on raising money from investors, we will be speaking with a legend in the real estate syndication business. We are speaking with Samuel Freshman, founder and CEO of Standard Management, a company he started back in 1961 to syndicate commercial real estate. In 1971, Sam literally wrote the book on real estate syndication, entitled The Principles of Real Estate Syndication. In its third edition, Sam's book offers entrepreneurs a step-by-step process to syndicate real estate investments. Also, his book is used by many educators as a manual and textbook on real estate syndication. In this interview, you will learn why Sam started his syndication business, the best way to get started in syndication without a track record, 3 critical money-raising activities you must be doing, how to safeguard your earnest money deposit when raising equity, how to get experienced syndicators to raise money for your deal, the biggest mistakes to avoid when syndicating, how to partner with Sam and other experienced syndicators, the best way to save on legal expenses when hiring an attorney. Sam syndicated his first deal over 40 years ago and has been through 5 real estate cycles. Whether you are a new or seasoned investor, you want to take note and listen to this high-value interview with Samuel Freshman. All right, Sam, so you are like a legend in the syndication business, and you got started many decades ago started out at the School of Law in Stanford. Can you share with us kind of how you got going? What was the transition getting into real estate syndication?
Yes, I originally went to law school on the advice of my father, who thought it was a good background for business, and I was supposed to go in business with him, but when I graduated, I told him that I liked the law and I wanted to practice, but I wasn't sure what I should go into. My father had recently moved to California, and he said, go into real estate law. That's where all the big money is made in California. He was a very smart guy. He'd only been out here 2 or 3 months, and he'd figured that out. And it was good advice. So I went into real estate law, saw that my clients were getting rich, and decided that I should get involved in development and acquisitions because I wanted to be rich too. That was it.
Well, I was going to ask you what got you so excited about getting into real estate syndication. I think you answered it. It was getting rich. That's
right. The thing that got me excited about syndication was that real estate is a leverage business, and syndication is just carrying leverage one step further. Positive leverage can enable you to make fairly high returns if you buy your properties properly, and if you leverage the equity as well by getting other people to put up the bulk of it and give you an override, while you can sometimes get 20, 30, 40% on your investment.
So leverage, that makes a lot of sense because you're getting other partners to put up a lot of the equity and you're still getting financing on the deal. So it makes sense.
Syndication is financing the equity the same way that you're financing the property, just carrying it one more step down the line.
Well, I want to ask you, Sam, if you think about it, you've been through 5, 6 real estate cycles, and with that experience, you see things a little bit different than everybody else. And I'm kind of curious how you see real estate syndicators, like if you're looking to where the puck is going to be, looking at where tomorrow's opportunities are going to be, where would you say that'd be?
Well, a lot of my sophisticated, smart friends have gone into student housing, which seems to be a place where there's a lot of opportunity. I think there'll be a lot of opportunity in secondary markets that are sort of overlooked right now. We're in a simple 2-tier system where There's very low returns on the major markets that are doing well, and relatively higher returns in the secondary markets. So those are two possibilities. I'm a contrarian. So when I call my stockbroker, I always say, what's out of favor right now? And then I look at that and see if I agree that that particular product has been over-discounted. Right now, the hot thing is apartments, so there's not going to be a lot of upside, I don't think, in apartments. A lot of people think there is, and therefore they're selling at very low returns. So you want to look for a product type where the returns are higher, because everything goes in cycles.
Yeah, you think about some of the markets that are really got hit pretty hard. Retail got hit pretty hard. Office market got hit pretty hard. Being a contrarian, maybe you see some opportunities in the office market.
Yes, well, the office market is an area where there's opportunity, particularly if you can fill it. We do a lot of lending, gap and bridge financing, and we lent on a guy who bought a 26% occupied office complex in Denver about 3 months ago, and he's already got it up to 50%. He's probably doubled his investment value in less than 3 months because he got out there, knocked on doors, and filled up the vacant space.
Created value.
Created value. That's where it is. You need to be careful because, we like leverage. Leverage is great on the way up, but it's disaster on the way down. So my one recommendation is that you don't over-leverage in this market because we don't know where the bottom is yet. It appears that in a lot of product types we are at the bottom, but we could further have another reversal and move down a few notches.
Well, Sam, I want to spend some time talking about your book. You wrote a book back in 1971. The name of the book was The Principles of Real Estate Syndication, and it's currently in its third edition. And this book really offers entrepreneurs like myself and others a step-by-step process to syndicating real estate deals. And I want to spend some time talking about it because this book is really a solid book that many of the institutions use as a manual and a textbook to teach the subject of syndication. I want to get a flavor for what got you excited. What was it that was the passion behind you writing the book?
Well, I used to get a lot of questions from people who wanted to go into real estate, either as investors or as the developers or syndicators, and I felt it's a rather complicated subject, but the principles are pretty simple. And if I could put them all down in a book, I could, instead of spending 2 or 3 hours answering their calls, I could say, just get the book and read it, and you'll know how to do everything I've done. For example, a lot of people don't understand that leverage works across the board with regard to real estate. You have the leverage, the difference between your cash flow and your mortgage payments, but you also have leverage on the appreciation, and and then there are tax benefits. So when you add all those up, and this is why in relatively good times the returns on real estate can exceed those that you get in the stock market, because when you add up all these different leverages, like say 3% for appreciation and maybe 4 or 5% on the cash flow, assuming that you have debt for 2/3 of the purchase price, every time there's a 1% increase in the overall return, that's and you have over and above your debt, that adds 2% more to your return, because your debt is twice as big as the equity. Sometimes it can be 3 times as big. You don't want to go over that, because then if the rents start to go down, you're going to be wiped out.
Yeah, too much risk.
Right. You got to remember, leverage is great, but the more leverage you have, the higher the risk.
what is a syndication? I know you can syndicate real estate, but there's other things you can syndicate as well. How would you define a syndicate?
Yeah, well, a syndicate, as you said, a syndicate is any time where one person puts up the bulk of the investment and the other party is responsible for the results of the deal. That also is not only a syndicate, it's also a security. And we'll talk maybe a little later in this conversation about what you have to watch with regard to the securities laws. But you have one party who's the investor, or a group of people who are the investor, and another party who finds the deal, puts it together, and runs it. A syndicate could be 2 people, or it could be 100 people. The number is not what makes it a syndicate. What makes it a syndicate is one person is relying on another for the results.
Well, let's talk about the guy that puts the deal together, the syndicator, the sponsor, if you will. What are some of the roles and responsibilities that person takes on in that syndication?
In the typical smaller private syndications, the sponsor finds the deal, arranges the financing, sets up the business plan, and runs the property. So he basically does all those roles. Now, sometimes the roles can be divided up. The thing that's always present is a sponsor or a syndicator who sort of puts the deal together either by himself or with other professionals and presents it to an investor or investors to invest in. So the
sponsor basically finds the great deal and packages it up and takes it out to the investment community.
Right. Now, sometimes he may hire a securities firm to raise the money, or finders to do that. He may hire somebody to manage the property. He's probably going to hire contractors to do that portion of it. He may use a mortgage broker to find the financing. But if so, he puts that team together, or he does a number of those functions himself.
And if you think about becoming a syndicator, I know others on the call are thinking about, gosh, I'd like to get into doing something this myself. What are some of the benefits? What are some of the reasons why someone want to get into it? I know we talked about one of the reasons is getting rich, but what are some of the other reasons?
Well, they're all related to getting rich, of course.
Yeah.
But let's say the syndicator is a real estate broker, and he knows how to buy properties and get listings. But if he just does it for a commission, he gets paid and he's done. Whereas if he syndicates it, he may be able to set up a cash flow source for the rest of his life on that particular project. So many times it's more profitable to syndicate rather than to be a broker and sell a property. And
in fact, a lot of these syndicators got started as brokers, didn't they?
Yes, or attorneys. In my case, I was an attorney, and I had clients who wanted to invest in real estate. So rather than just drawing the papers up, I could get myself a piece of the deal by finding a deal, syndicating it, and getting my clients to invest. So he might be a broker, he might be a attorney, he might be an insurance broker, he might be an architect who's got an idea for a building. There's all kinds of different careers and professions that can benefit by being involved in syndication.
And so let's say you get involved with something like that. What's the downside? What are some risks that syndicators take on in that role?
Well, if they don't not careful to follow the law, they could violate the security laws, in which case they end up guaranteeing indirectly the investor's investment. In some cases, the syndicator has to be the one, because most investors aren't going to agree to personal liability. So the syndicator, if it's a recourse loan that has to be guaranteed, the syndicator is the one that has to put up the guarantee. So there are a number of things that the syndicator has to be careful about, some of which you can eliminate through good planning, and some are just maybe in the nature of the particular deal that will create some risk. There's obviously time that's necessary to manage the property, and if you don't give it attention, it's probably not going to work out. So that has to be considered, whether or not you have the time and resources and the information to properly run a property.
Well, I know a lot of sponsors thinking about getting into the business, they worry about maybe at some point something going wrong and being sued by the members or limited partners, the passive investors. What would you say to that?
Yeah, well, I would say you have to be more careful as a syndicator than you are with your own investments, because you could possibly end up with criminal convictions and other things if you're not very, very careful about how you syndicate, how you make sure you comply with all the laws, you have all the disclosures, and that you've identified all the problems with the particular deal. There's a lot of people that have gotten in trouble because it was easy for them to raise money, but they didn't know what they were doing, and they bought projects that were obviously going to fail. So you've got to be very careful with the selection of the property and err on the conservative side. One of the things is what you promise or what you indicate. If you tell people they're going to get 8% return and they only get 6%, some of them are going to sue you. If you tell them that you think, based on your understanding that you'll probably get 8%, you tell them they're going to get 6%, and then they get 8%, they're very happy. So you always want to under-promise. It's a great way to avoid being sued. Always indicate in your projections something less than what you actually feel it's going to do.
Well, I would also say that I would recommend, I'm sure you recommend the same thing, is make sure you have good legal counsel advising you along the way.
Yes. Well, as I said, a lot of syndicators are lawyers because the nature of all the laws that apply to it. But if you aren't, you want to have good legal counsel, you want to have a good accountant, you want to make sure that all your vendors are properly insured, you want to be sure that you have proper insurance on the project. You put together a team, and that, depending on what your skills are, that team could be any number of people. There might be 5 or 6 people on the team in a large project. But just you've got to make sure that everybody knows what they're doing, has a good reputation, and is well qualified for what they're supposed to contribute to the project.
Yeah, and I know a lot of new syndicators that are just kind of getting going. They're thinking, gosh, I want to spend the money on the legal counsel, and I'm just going to buy a small property. And a lot of them decide, no, I'm just going to do it on my own and try and put something together. What would you say to that?
Well, I would say if you're using your own money, that's fine. But if you're going to use other people's money, you better be sure that you know what you're doing and you've been through that learning stage. Maybe intern or work for a syndicator for a while or a developer before you actually go out and start doing it.
Well, let's look at from the investor standpoint, the passive investor, the one that's going to give the sponsor the money. What are 2 or 3 things or reasons why that passive investor would give the money to the sponsor?
Well, I think that one is the track record of the sponsor. The sponsor has a good reputation in the community and a good track record and knows what he's doing. You'll avoid a lot of the risks and the project will have a higher degree of success. So basically what you're doing is you're not really investing in the project. You're investing in the syndicator. And you want to spend as much time or more on checking his record, reputation, and ability than on the project itself. That's one. Another is that you can get larger projects. If you have a limited amount of money, you may have to buy something that's small and where you have to, if the tenant's toilet overflows or whatever, they're going to call you. Whereas if you buy a 200-unit building, you can afford to have on-site management. And there's actually the larger projects require less time than the smaller projects. So it may be a matter of the personal time that you have. You don't have the time really to be a landlord. So you're laying off that time commitment onto the syndicator. And you can usually buy a better quality property if it's a larger property, and more easily afford the proper management. And if it runs into trouble, you can afford to have reserves to prepare for that. So actually, if the syndicator is qualified, it's probably less risky to go with a syndicator than it is to go on your own. You're going to give up some of the profits for that, but you're going to reduce your risk.
Well, let's say somebody's new getting going. They don't really have that track record. Maybe they're a real estate broker and they've been doing it for a number of years, or a property manager or an attorney, but they don't really have that track record of putting together their first deal. How would you overcome that?
Well, most of the people that I've seen that do this go to work for somebody, or they partner with an established syndicator on their first deal, rather than attempting to do it all on their own.
So bring in somebody that's got the experience.
Bring in someone that's got the experience and do the first deal with them. That would be my recommendation. Some people, there are attorneys that specialize in syndication, and you can buy some of that expertise or guidance, but that's expensive. I know I started probably 20 or 30 people in the business during my law practice, but they would have probably been just as well off starting out partnering with somebody that rather than having to pay the hourly rate that I was charged.
Yeah, and I think when you got started, your first deal, if I recall, didn't you raise like $300,000 or $400,000?
Yes, my first deal was $300,000.
And you bought what was this?
40 years ago.
Yeah.
In my first deal, I had people invest as little as $3,000. Today, if I could find a property that I wanted to syndicate, I probably wouldn't take less than $100,000.
Right.
Our average investor now puts in about $300,000. We have people that put in as little as $100,000, and some that put in as much as $1 million. But when I started out, I raised $300,000 from about 30 people, and some of them had as little as $3,500 in it, as I recall. As time has gone on, I've had less investors per deal, but with much higher amounts per investor.
Well, one of the big worries or concerns that syndicators have as they're kind of getting going, that they're going to put a property under contract and they can't raise the money to close the deal. They're worried about that. What kinds of safeguards or things sponsors should do to protect themselves in that event? What would you say?
Well, first of all, you better not do that. I know many people who've lost their deposit money because they got started, they were optimistic, and then they weren't able to raise the money, and they lost their forfeitable deposit, because you have to put up a deposit usually to tie up the property. So number one, I would, in your first couple deals, until you build up some reserves, partner with someone that has the money to close, or set up a line of credit with your bank if you can. When I was starting out, I would figure out how much I could raise and how much I might be short, and then I would get the bank to give me sort of a standby that they'd fund, and then I'd raise the rest of the money afterwards. So let's say I'd have to raise $600,000, and I had commitments which I could rely on, and just remember that you have to figure a percentage of the people that said they're going to invest are going to drop out. One of the things when you're marketing is to remember that to ask everybody, because I found I'll start out with 50 names, and 25 I think are going to invest, and 25 I think probably won't, but I'm going to talk to them anyway, and I end up getting more of the money from the people that I thought were not going to invest than I get from those that I thought were going to invest. You just never know unless you ask.
Well, let's talk about marketing, because I know in Chapter 17 of your book you talk about how to market syndicate shares, syndicate interests. So For a new investor, what would be maybe 3 or 4 big money-raising activities that they should be doing to find those new investors?
Well, first of all, you don't want to start out with new investors. You want to start out with making a list of your relatives, friends, and contacts. Your team can be a broadening source, like an attorney, an insurance broker, a real estate broker, the banker, people who are centers of influence, who might know people that would invest. I would not spend a lot of money trying to raise money, particularly in the beginning. I see so many people who fail because they spend a lot of time raising money, but then they never could find a good deal. If you have a good deal, a deal that really makes sense, and your investment pool is limited, go and find a syndicator who's got a group of investors. My experience, I've been in this 55 years. I've never lost a deal over raising money. I've had probably hundreds of calls of people offering me money, and I've lost them because I haven't had anything to put them into. So I would say the biggest mistake new people make is focusing on raising the money versus finding the deal. You've got to have a good deal. You have to be able to control it, and then either bring in other people, as I say, attorneys or insurance people or others who have groups that they can contact if your own contacts are not sufficient. You want to be very careful. For example, a lot of people make mistakes having public meetings. If you have a public meeting for the purpose of raising money on a specific deal, that's probably going to violate the securities laws, because unless you've registered, and which is very expensive, you're limited to no more than generally 35 offerees. That's not 35 investors, that's 35 offerees. So the minute you start having public meetings, you've violated that. You can have meetings to educate people about real estate, but you can't offer anything for sale at those meetings. So it's a long and involved process. The best thing is to work on personal contacts and networking through your advisors and relatives and friends and business associates and so on.
Yeah, no, I think finding a great deal, like you said. Oh man, that's great advice. If you find a great deal, it gives you lots of opportunities. But I wanted to drill down a little bit farther on this broadening source, because that's a great idea. There's a lot of centers of influence that know other people that have money, and that's kind of what you're talking about, right?
That's right. Your banker, your accountant, all of those people are good, and that's where I got my original investors, was through those kind of sources. I never placed an ad, and I never ran a public meeting in my entire 55 years. I've always been able, if the deal was good, to find the money, or to go to someone else who could raise the money and partner with them.
Having the great deal is more important than the money out of the gate, because if you have the great deal, the money will come to it through some of those broadening sources. Right.
And it's a good way also to determine whether the deal is good. If you go to an experienced syndicator and you say, you want to partner with me on this deal, if he says, yeah, I'll raise the money, and he'll put up his share of the costs and so on, or maybe fund all of them, then you know you got a good deal. If he says, no, I don't think so, then probably you should just pass and move on, because he probably knows whether or not you're going to be able to raise the money.
I'm going to drill down a little bit on that just to give some more information. So let's say in that scenario you find a great deal and you go to a syndicator. One question would be, should you have the property tied up before you go to the syndicator? And two, generally speaking, what types of splits could you expect to get generally?
Well, if somebody comes to me and they have a deal that matches my parameters, I'll give them anywhere, depending on how involved they're going to be. If they've actually got it tied up in escrow under a contract that I'm comfortable with, I might give them as much as 25% interest in my profit, somewhere between 10 and 25%.
Okay.
And that's if I'm raising all of the money. If I'm raising half the money, it might be just a 50-50. You know, they raise half the money, I raise half the money. We just split it right down the middle. Depends on the deal and how much is there, but generally, as I say, I'm looking for deals, not investors.
That's great advice, Sam. I really appreciate that. And I know a lot of sponsors are out there new, making mistakes. What would you say a few of the big mistakes that they're making as they're raising money for their deals?
Well, one is just thinking that it's easy and buying the wrong property. That's, I'd say, the biggest mistake. The second biggest mistake is not making full disclosure of there's no such thing as a perfect deal. Every deal has problems. So disclosing all the problems, failing to disclose all the problems and all the risks. If you tell somebody that they could lose their money and here's the risk, it's very tough for them to sue you later if it doesn't work out. But if you don't do that, pretty easy, you know, as I used to tell, my dad would say, well, why is this guy suing me? He doesn't have a cause of action or anything. I said, Dad, anybody with $19.50, that was the filing fee at the time, can sue you. And they may not win, but you're going to spend a lot of time and money defending yourself.
Yeah, so it's more important to disclose too much than not enough.
That's right. Always err on the side of full disclosure. Don't take any widows and orphans. I never take anybody who can't afford to lose the money. That's another way of protecting yourself. You want people who are sophisticated, or this is money that they can afford to lose. Many times there'll be widows, people like that will come to me with fairly substantial amounts of money, but I know that that's all they have. I have one woman who always wants to give me $500,000, and I won't take more than $100 from her on any particular deal because I know she relies on her assets and she doesn't have an independent source of income. And fortunately, everything's worked out, but I have to be able to cover it if something goes wrong. Most real estate deals work out in the long run, but sometimes they need help. When you don't make your projections, you may have to put some money in. Well, the investors aren't going to do it, so you better be prepared to save the project.
Well, I appreciate you taking your time and going through all this. You gave us a lot to chew on, and I know your book is a great source for education. I highly recommend it. Again, the name is Principles of Real Estate Syndication. Tell us where our listeners can go to buy this book.
Well, probably any local bookstore can order it, or you can get it on Amazon, or you can get it on e-books or Kindle. Any one of those sources. It's I think we've sold about 50,000 copies, and I get emails from people all around the country who with questions. So I know it's not too hard to acquire. I wouldn't recommend the e-book because the book is pretty big, and I find most people want to use it for designing forms and things like that. So I think if you're serious about it, you probably should get the hard copy.
And in the book, you do have a lot of the forms and agreements in there as well, right?
Yes. Yeah, remember those, you have to tailor those. You want to definitely, if you're going to rely on that, one way of saving money on your legal expenses is to draft your documents first and then take them to the lawyer to review and improve on. And the book will help you do that. But you never want to use anything without having the lawyer check it over because the laws are different in various states, and they do change from time to time. And each project is a little different. But there's nothing wrong with it, and I recommend that you try your hand at it first and then take it to the lawyer, because the more information that you have for the lawyer, since they charge by the hour, the less it's going to cost you.
I hope you enjoyed this interview. For more information on Samuel Freshman and Standard Management Company, please call them at 310-410-2300 or visit their website at www.standardmanagement.com. For any other questions, comments, or ideas, please email me at craig@valuehuntacademy.com.